Hey everyone, good afternoon and welcome to the Marketplace Conference. My name is Roger Lee and I work at Battery Ventures. I'm lucky enough to be one of the co-hosts of the event and I'm really grateful that you're all willing to take time out of your busy schedules to be with us today. Normally, I give my State of the Marketplaces presentation at the beginning of the first day, but given we started so early and I live in California, I really appreciate that you guys are willing to let me go later in the afternoon. So with that, let's get started. As I said a second ago, I work at Battery Ventures. We're a global venture capital firm that has $9 billion under management. We just raised our most recent fund, Battery 13, earlier this year. It's a $2 billion vehicle, and we're totally stage agnostic. We do everything from very early stage investing, where we'll give a founder $500,000 to get their idea off the ground, all the way up to $100 million pre-IPO growth equity financing. We also operate globally. We have 2 offices here in California, 2 on the East Coast, 1 in London, and 1 in Israel. Most importantly, we love marketplaces. This is one of my favorite slides of the presentation. Over the past 10 years, we've invested in over 20 different marketplaces that we've listed on this slide. These range from e-commerce marketplaces like Wayfair and StockX to community and content marketplaces like Glassdoor and Marco Polo, local services marketplaces like Angie's List, travel marketplaces like Hotel Tonight and Airbnb, and financial marketplaces like Coinbase. Across this marketplace portfolio, we've invested almost $400 million. This has been a very big area of focus for us. Most importantly, we'll continue to aggressively invest in marketplaces across both Europe and the United States going forward, so we are very much open for business. So that begs the question, why are we investors in marketplaces? Why do we like marketplace businesses so much? The answer is that we look for businesses that fundamentally change the way consumers behave and create a lot of value as a result. And if you look at marketplaces, they have done this in a huge way over the past couple decades, generating great returns for their investors. In fact, there are 4 marketplaces that are in the process of going public right now: Instacart, DoorDash, Wish, and Airbnb. These 4 companies have become household names and have changed the way we shop, buy groceries, get meals, and travel. We'll see how the IPOs play out, but I'm guessing that these 4 marketplaces will be worth over $100 billion when they go public. That's an amazing milestone, and it shows that when you build a marketplace correctly, with strong network effects and compounding moats at scale, you can create a hugely successful business. So shortly after these 4 companies go public, they will join the Battery Marketplace Index. This index tracks the world's largest publicly traded marketplaces, and as you can see, it has handily outperformed the NASDAQ over the past 8 years, generating a 400% return, while the NASDAQ has returned 280%. Even more interesting is if you look at the bottom right of the slide, it shows what's happened over the past year, and in particular, shows the impact from COVID in March. Since that time, the Battery Marketplace Index has had 2 times the performance of the NASDAQ, returning 82% versus 41% for the NASDAQ, and virtually all of that performance delta happening since COVID. So what happened? Why did the Marketplace Index outperform the NASDAQ so dramatically since the onset of COVID? And more importantly, what can all of us as investors and founders learn from the past 6 months to make sure we're positioned for the most success going forward? To answer this question, we have to take a big step backwards and simply acknowledge that COVID has been a fundamental reset across the board. It has changed the way we live, the way we work, the way we interact with others, the way we educate our children, the way we entertain ourselves. It's really changed everything. In fact, it's hard to find something that COVID has not impacted. Not surprisingly, these changes in consumer behavior have had a dramatic impact on the companies operating in those underlying industries. Some of these companies have seen huge accelerations in their business, while others have been slowed to a crawl. When you unpack the various segments of the Marketplace Index, you see a very clear list of winners and losers from these behavioral changes. Companies that were indexed to remote work, digital health, and e-commerce benefited enormously as people started working from home, seeing doctors remotely, and purchasing everything online. In some of these industries, you're seeing 2 to 3 years of behavioral shift get accelerated in 3 months. This has driven massive revenue growth for these companies. Conversely, if the company is indexed to travel, particularly business travel, or events and ticketing that require large groups of people to get together, those companies have seen huge slowdowns as people stop traveling and moved much of their entertainment to online or digital channels. This slide shows how extreme the gap is between the winners and losers from COVID. On one end, you have companies indexed to the future of work whose shares appreciated 343% over the past year, while the events and ticketing space experienced almost a 50% decline. This slide cuts the data another way and shows the multiple expansion the winning categories enjoyed over the past year. So not only did they see a surge in business, but their valuation multiple grew as well. Specifically, this slide shows the company's multiple as a function of the next 12 months of revenue. For example, the revenue multiple for future of work marketplaces grew from 4 times revenue to 15x revenue over the past year. Needless to say, that's a huge increase. Now, the other winning categories also enjoyed significant multiple expansion, but it was not as extreme. As you can see, digital entertainment, e-commerce, education tech, and digital health marketplaces all expanded their multiples by 40% or more. So at one level, it's interesting to unpack the various subcategories of the marketplace index and see how they performed. The more interesting question, however, is to ask why? What was going on behind the scenes that allowed these businesses to thrive in a post-COVID world, and what can we learn from them? In particular, what changes do we think will persist post-pandemic, and which ones will quickly fade into the rearview mirror? To answer this question, we've researched the underlying behavioral and market forces that drove this separation between the winners and losers. We've summarized them on this slide into 2 different categories. At the top, we have 5 tailwinds that are driving significant adoption of the marketplaces in these underlying verticals. These tailwinds range from regulatory changes that benefit certain companies, to mandated adoption of new digital communication tools, to completely new ways of consuming entertainment content. On the bottom, we've detailed 2 headwinds since COVID-19. One of them is a behavioral change, and the other is a regulatory challenge that has become necessary as we prioritize public health. So let's dive into each of these tailwinds and headwinds to better understand what's going on. The first tailwind relates to a range of regulatory changes that have been passed to facilitate digital health. Pre-COVID, it was challenging for doctors to get reimbursed for a wide range of telehealth use cases due to archaic definitions of what qualified as a doctor's visit. As a result, doctors were reluctant to adopt telehealth options as they could not get paid. This was a huge impediment to broad adoption of telehealth and really stifled the development of the industry for years. And then COVID happened. If patients and doctors are not able to see each other in person due to a public health crisis, we have a big problem. If patients and doctors have no choice but to see one another over video, and doctors are still not getting paid, we have an even bigger problem. Thankfully, the government quickly responded to this issue and rewrote the regulations that allowed doctors to get fully reimbursed for a telehealth visit at the same value as an in-person visit. Not surprisingly, this created a huge incentive for doctors to transition to telehealth-based care, and the market has taken off over the past 6 months. The best way to show the impact of this regulatory shift is by looking at Teladoc, a leading marketplace for telehealth services. Since the changes took place, they have seen a huge surge in interest from both doctors and patients. As we highlight on this slide, 89% of consumers think that telehealth can replace most of their in-person appointments. And more importantly, 57% of doctors view telehealth more favorably, and 64% are more comfortable using it. This has yielded very impressive financial performance for Teladoc, where visits have grown by over 200% and revenue has grown by almost 70%. This has led to an increase of their market cap from $12 billion a year ago to over $30 billion today. To be clear, this is not unique to just Teladoc. Virtually every company in the telehealth space has experienced a similar acceleration. So it's a great example of how a specific policy or regulatory change can have a hugely positive impact on an industry. The next tailwind relates to the future of work and the rise of the freelancer. With unemployment rates increasing and everyone working remotely, the definition of an office and an employee has shifted dramatically. In a pre-COVID world, we all had to live and work in the same community and congregate in a shared office to get our jobs done. Post-COVID, that's no longer the case. Employees are free to live anywhere, and everyone is getting used to working remotely. As companies learn to work remotely, it immediately opens the door to hiring people from all over the world who can get the job done. Since everyone's going to be remote anyway, I might as well tap into the broadest labor pool possible to attract the best talent. This has led to a surge in demand of online labor marketplaces that allow you to find freelancers from around the world who can get a specific job done for you. Whether or not you're looking for logo designers, video editors, or software developers, these labor marketplaces have become the go-to destinations for both supply and demand looking to get a job done. The marketplace who has been the biggest beneficiary of this tailwind is Fiverr, which is an online marketplace for freelancers. After a very quiet first couple of years as a public company, they've seen a massive spike in demand post-COVID. In fact, they're one of the best performing stocks in our marketplace index, with their shares appreciating over 750% over the past year. There are other labor marketplaces like Upwork who have also benefited from the remote work tailwind, and my guess is that this trend will persist in the years to come. The third tailwind is the rise of digital education. With COVID shutting down traditional in-person schools, students, teachers, and families have had to adopt new tools to fill the gap. These services range from products that help young kids learn how to read and do math, to college students getting assistance with homework and exams. Interestingly, the pandemic has also fueled growth in adult learning, as many people in their 30s, 40s, and beyond go online to learn new skills that can help them advance their career. This category is called upskilling or reskilling of the workforce. Whichever way you look at it, digital education is experiencing a watershed moment where a generation of students of all stripes are experimenting with and adopting educational marketplaces to help them learn. One education marketplace who has benefited from the tailwind is Chegg. Over the past year, Chegg has seen their subscribers grow by almost 70%, driving revenue growth of almost 50%. This financial performance has driven a more than doubling of their stock price over the past year, and they're now worth over $11 billion. As a father with 3 kids who are doing distance learning, it's clear that remote schooling has pros and cons. On the one hand, I think I can speak for most parents and say that I'm excited for the day when my kids can all safely go back to school. However, once they go back, I think there'll be a suite of education and content marketplaces that will supplement the in-person experience and help students learn more effectively than they have in the past. The fourth tailwind will be no surprise to anyone in the audience, and that is the rapid shift from physical retail to e-commerce. This trend started over 10 years ago, but it dramatically accelerated in the past 6 months. In fact, if you look at the chart on the left, you can see e-commerce penetration as a percentage of total retail sales. As you can see, from 2009 to 2019, this number grew roughly 10%, from 5.6% to 16% penetration. Then, in a matter of 2 to 3 months earlier this year, it grew another 11% to 27% penetration. Think about that for a minute. Pre-COVID, it took the U.S. 10 years to shift 10% of retail sales online. Post-COVID, it took roughly 2 months to shift the next 11% online. That's an incredible shift in behavior. So why did this happen? As we all know, we couldn't go to physical stores anymore, so we didn't really have a choice. We had to purchase everything online. That shift in behavior drove huge growth and value creation across many e-commerce marketplaces. We've listed some of them on the right side of the slide, like PDD, Etsy, Wayfair, and Farfetch. All of them saw their revenues accelerated by 2 to 3 years, which drove huge appreciation in their equity value. They're now trading at 2 to 3 times what they were pre-COVID due to this huge behavioral tailwind. The fifth tailwind is another one that won't be a surprise, and that is our behavioral shift towards digital entertainment. This is another trend that's been in the works for a while, but people are increasingly shifting their focus towards consuming media through online channels. The big shift that happened earlier this year relates to the movie industry. This is an industry with very archaic distribution models, where studios would lock arms with physical theater chains who would have exclusive rights to distribute the movie during the first few months after the release. This model's been in place for decades, and even though it's been under assault for the last few years, it has largely stayed intact. And then COVID hit. With every movie theater shutting down, the studios had no choice but to release their movies direct to consumers. Not surprisingly, this has been a huge success, and it opens up a whole new channel and use case for digital entertainment. We highlight what happened with Trolls World Tour on this slide, which generated $100 million in 3 weeks through a direct-to-consumer streaming model. This is more revenue than the first Trolls movie made during its entire domestic run. We don't have access to the financials, but it's almost certain that this was far more profitable than the movie studio, as the revenue share agreements with the streaming platforms are much more attractive than the theater chains. Not only are movies bypassing the theaters and coming direct into our homes, but we also have more time in a post-COVID world to consume this entertainment since we're not going out as much. This is driving a significant increase in consumption of digital media across all audio and video streaming platforms, ranging from Netflix and Hulu to Spotify. Personally, I'm looking forward to the day when I can go back out again, go back to the theaters, and watch movies on a big screen. But in the meantime, this behavioral tailwind is hugely benefiting all of the digital entertainment marketplaces. So, those are the 5 key tailwinds. Let's quickly switch gears and talk about the 2 big headwinds that have emerged post-COVID. The first, not surprisingly, is that travel has slowed down dramatically. The pandemic is impacting both leisure and business travel, and I'm sure everyone participating in this event has shifted their behavior accordingly. What's interesting, though, is that travel comes in many forms, and the pace of recovery will be different depending on where you sit in the travel ecosystem. For example, early data would indicate that even though both Uber and Lyft suffered over the past year, they're starting to see early signs of a recovery as people look for convenient forms of local transportation. This has led to a pretty good recovery for those companies since their lows back in March. Conversely, the data also shows that people are less likely to fly on planes, stay in hotels, and attend conferences. This has led to a much slower recovery for the travel marketplaces like Booking.com and Expedia that are indexed to flights and hotels. What will be really interesting to see over time is what these numbers look like in 2, 3, or 5 years from now when COVID is in the rearview mirror. In particular, I'll be paying a lot of attention to business travel. My sense is that video has now become a totally acceptable platform for meetings, which could significantly reduce the need for business travel in the future. The second and final headwind that we'll discuss is the behavioral shift away from in-person events. The Marketplace Conference and this digital experience is a microcosm of this issue. As public health became the priority post-COVID, all live in-person events were canceled. That forced all event organizers online to try and replicate the experience over video. Any marketplace that was tied to in-person events, conferences, or ticketing was hit really hard by this transition, and we're highlighting Eventbrite on this slide as an example. As COVID started to spread in the first half of this year, they saw revenue and paid tickets drop by 80 to 90% as people stopped going to in-person events. To their credit, they quickly pivoted their model to enable digital events, which is helping their recovery, but this headwind was an existential challenge for the company. So that's our summary of the headwinds and tailwinds that have emerged since COVID. Now, if I'm a founder in the audience, I'd be asking myself, what do I do with this information? How do I manage my marketplace in a post-COVID world? To answer that question, we want to highlight a few key takeaways that you should all be thinking about. First and foremost is to always focus on the efficiency of your marketplace. This will help you survive in a headwind and thrive in a tailwind. The second is to prepare your workforce for the new normal. Working norms have shifted over the past 6 months, and founders must be conscious of these changes and manage their teams accordingly. Finally, is to think deeply about what the post-COVID world will look like and make sure your marketplace is indexed to the right trends. Consumer behavior is changing more during COVID than we've seen in a generation, and you need to be really thoughtful for how your marketplace is indexed to those shifts. So let's spend a minute diving into each one of these. So, priority number 1 is to focus on business model efficiency. For those of you who attended the Marketplace Conference earlier this year, we talked a lot about the impact that business model efficiency has on your marketplace valuation. Specifically, we talked about using the Rule of 40 as a framework to measure efficiency. As a reminder, you calculate your Rule of 40 by summing up your revenue growth rate plus your EBITDA margin. So if you're growing 100% per year with negative 50% EBITDA margins, your Rule of 40 is 50. If you're growing 25% per year with 10% positive EBITDA margins, your Rule of 40 is 35. Any Rule of 40 number that's 40 or higher is really good and shows strong balance between growth and profitability. Any number that's well below 40 or potentially negative is a big red flag that something is not working in your business. Interestingly, the Rule of 40 is a great predictor of value creation. The higher your Rule of 40, the better your stock will do. Conversely, the lower your Rule of 40, the worse it will perform. This slide shows the correlation between those two variables and also how broad the separation is between the winners and the losers. As you can see, the public marketplaces with the top decile Rule of 40 scores saw an average of a 441% positive return, while the bottom decile Rule of 40 companies were down 43%. Looking back, 2020 was a period of Darwinian separation, where the strong and efficient marketplaces were rewarded and the weak marketplaces were exposed. And not only is the Rule of 40 correlated to stock price performance, it also drives your valuation multiple. The higher your Rule of 40, the higher your multiple. As you can see on this slide, marketplaces that have a Rule of 40 that's above 40 trade on average for 11.5 times revenue. If your Rule of 40 is below 40, that average is 4.3 times revenue. So the key takeaway for marketplace founders and CEOs in the audience is that you will greatly benefit by using the Rule of 40 to help balance growth and burn in your business. It will give you a simple framework to manage the tension between those two forces, and if you can operate the marketplace at a Rule of 40 or higher, you will be richly rewarded. Your marketplace will trade at a premium multiple, and it should generate great returns for you, your employees, and your investors. The second priority to think about in this post-COVID world is preparing your workforce for the new normal. To be clear, this is relevant to all organizations, not just marketplaces, but all the leaders in the audience should be conscious of these trends. A lot has been written about what office life will look like in the years to come, and there is no one right answer. But the data would indicate that a few things will almost certainly change. First, remote work will be increasingly prevalent. Video conferencing is now a standard means of collaboration, and many companies are enjoying higher productivity post-COVID as employees live where they want and do not have to commute. Second, promote a culture of continuous learning. Companies that support lifelong learning are thriving as 20, 30, and 40-somethings look at opportunities to upskill and reskill themselves for an increasingly digital world. Third, and maybe most important, is the increasing need for companies to assist their employees with mental health services. The pandemic has shown a bright light on the world's mental health challenges, and many companies are stepping up to provide mental health support for their employees. The trends would indicate that mental health will soon become the fourth pillar of employer health benefits after medical, dental, and vision. The third priority to think deeply about what the world will look like after the pandemic is over is to do your best to ensure that you're indexed to the right trends. We've talked a lot in this presentation about the various headwinds and tailwinds that are impacting companies today, but the real challenge is to look into your crystal balls and try to predict which changes will persist, which will fade, and predict what the world will look like in a few years. For sure, it will be different than today, and the billion-dollar question, or maybe $100 billion question to the founders in the audience is what marketplace can they build that will leverage those changes and provide a new service that was not available in the past. The questions on this slide about the future of telehealth, remote work, physical retail, e-commerce, and travel are all critical ingredients to this question. Now it's up to all of you in the audience, all the great founders out there to build amazing marketplaces that will reinvent the future and make the world a better place for us all. As I said at the outset, we love investing in marketplaces, and we will continue to aggressively do so. Given the pandemic, these are hard times to start and build a company, but we're confident that many great businesses will emerge during this period. As it stands today, the total value of the battery marketplace index is over $2 trillion. With the IPOs of DoorDash, Instacart, Wish, and Airbnb, we'll add another $100 billion to this number in the coming weeks. That sounds like a lot, but we continue to be very bullish long-term and think we're just getting started. We're just scratching the surface on how marketplaces will change our lives and think this next generation of marketplaces that all of you in the audience are creating will make the current crop of marketplace companies look boring by comparison. My hope is that Battery will get to serve some of you on your journey, so please don't hesitate to reach out. My contact info and the contact information of my team are on this slide, so again, don't hesitate to reach out. Thanks so much for your time. Enjoy the rest of the conference, and we'll see you back here tomorrow morning.